seriously, planning age pension.
Yep.
A lot of us are aging more with mortgages still. So if someone knocks on the Centrelink door at age 67, they've got the house, they've got debt. Talk to us about debt. Also, let's talk in this debt category about personal loans, car loans. Take it wherever you want.
Okay.
And you're a good guest because I don't have to do much talking. So
No, you be comfortable. I'll be here for a while.
Awesome.
Okay, so first thing, let's talk about the family home. So for most people, the family home is an exempt asset when it comes to any payment eligibility with Services Australia. Now that, $1.2 million property or a $700,000 property, it's an exempt asset for most people. Mortgages on the family home, because the family home doesn't count, mortgages on the family home don't have any implications either. So from that perspective, if you rocked up with a $1.2 million property with a $600,000 mortgage, it's irrelevant. We don't pay any attention to it. Where it makes a difference, and this is a very common strategy that people use, is that I have a $200,000 mortgage and I have $200,000 sitting in a mortgage offset account. Now, from a bank's perspective, they're neutralising each other out. It's not an issue. From a Services Australia perspective, that $200,000 mortgage offset account is a bank account. Therefore, it's what we would call a deemed financial asset, and we're going to count it for a pension eligibility. To give an example, had a gentleman rocked up.
Are you giving information to say the day before you apply for Centrelink, maybe close the offset account and commit the money to the mortgage forever, amen?
Well, not necessarily the second part, but I did have a gentleman where he sat down with me and I pointed out, because this is what the rules are, that he wasn't eligible for a pension because he had $400,000 in a mortgage offset account. He came back 2 days later and reapplied for the pension and could be granted because he put the money back onto the family home. The mortgage offset account disappeared. It went into the family home. Now, you've then got issues of why did I have the mortgage offset account in the first place? Was it because I wanted to have access to capital? And then you want to have potentially conversations with your professionals about, do I want to shut the mortgage down completely? Do I want to keep it open to be able to draw down on in the future? Without having to start a new reverse mortgage or something along those lines. That's a professional conversation which we would say you need to talk to them about. But from our perspective, any money that's put into the family home, even if it's money spent on renovations, disappears. We don't count it because it's the family home. If I put in $120,000 to do a massive reno of the kitchens and the living rooms, then that's your money. Family home is an exempt. We won't pay any attention to it. So it's the idea of the money in the family home is fine. When it comes to other investments, though, that's a different story. So if I have an investment property or a holiday home, so they're assessable assets, so they are going to be counting in what we're looking at for your pension. From a Services Australia's perspective, we can reduce the value of those assets by any loan secured against that asset.
Okay, so we net off the debt effectively.
We do. But it's got to be the security for the loan. So if I had a $700,000 holiday home with a $300,000 mortgage secured against the holiday home exclusively, then the asset is the $400,000 difference. Now, often banks don't like that so much, and so they want the family home involved in the conversation. So the mortgage may be secured between the two, shared between the two properties. We will then apportion the mortgage depending on the value of the family home in comparison to the value of the investment property, and then we'll proportion the mortgage in the same way. So it may be that of the $300,000 mortgage, $100,000 of it is attributed against the investment property, $200,000 is attributed against the family home. So we don't count the $200,000. If the family home is the only security, then all of the investment property is going to count. So the whole asset will be the same. Now, that's the same for things like margin loans on shares. We can do that as well. We can also do it on loans against cars. But any unsecured loans, we can't offset those against anything. But in saying that, if I have, I'll choose our famous...
okay, so I'll pull you up there. Yeah. An unsecured loan, for example, you purchased a car worth $20,000 and you did that with a personal loan or credit card. We can't remove that value of the $20,000 car.
Correct, because there's no document that says that the car, if something happens, they can sell the car to pay off the loan.
Yeah. However, if I had a car loan secured against the car, I can net off the loan amount. Okay, cool.
Yes.
So $50,000 car with a $40,000 loan, my car value is $10,000 for Centrelink.
Correct.
Okay.
Yeah,
awesome.
that'd be right. So the unsecured loan, the one I was going to mention is your classic one, is the one that you already brought up, is your credit card debt. So if I've got $100,000 in the bank account, I've got a $20,000 credit card debt. If I use $20,000 to pay off that credit card debt, that's a legitimate loan. That's a legitimate expense. That money's gone. We'll count the money that you've got left over after you've paid it. So any properly documented loans, and that's often where people fall apart because families do strange things amongst families. But any properly documented
You've talked to a lot of people, haven't you?
Many people coming out with many arrangements. When you've got a properly documented loan, any money you use to pay that off, we'll acknowledge that money's gone. There's no issues from that. So we'll just look at what's left over after it's been paid.
Okay. Can I ask a couple of tricky questions?
Go for it.
And everyone, just a shout out, Justin is here today with Christy from Services Australia. So thanks for coming up, Christy, and thanks to Laura in the team as well for organising this. Christy, I think we might try and trick Justin here to see if we can try and trick him. If, for example, and I would never put any gotcha stuff on the podcast, anyone, so if whatever you hear, it's all good. If, for example, so when you go for a mortgage in bank land, they will ask you, hey, what's your maximum credit card limit? Mm-hmm. And if you've got a $30,000 credit card limit, the bank will assume that that's fully drawn.
Yep.
Okay, for accessibility.
Yep.
Is there any weird way in Centrelink where I've got a $30,000 credit card limit and $30,000 in cash? Can I say, well, I could draw that credit card any time and, cook the books that way?
No.
Okay, cool.
No. When we look at your circumstances, we're not actually – there's no question in your claim for a pension that asks you what's your credit card limit.
Or forward plans?
No.
Okay.
Not even that. And there's nothing that even asks you how much do you owe on your credit card at the time of application. So we don't even ask the question. We're just going to say, what's the balance of your bank account? And you'll say there's $30,000 in the bank and that's it, end of story. If you then pay off the credit card debt, you come in and here's my credit card statement to show that I've paid off the credit card debt and bank balance has gone down, fine. We'll acknowledge it at that point. But they're not questions we're even asking. When you lodge an application for the pension, it's realistically just a photo of your circumstances
snapshot
at that point.
Yeah.
How much have you got at the balance of it? If it changes in 2 days' time, you tell us about the change in 2 days' time. But what is your circumstance? If I'm applying on the 2nd of July, what is your circumstance on the 2nd of July? That's going to determine your pension rate at that point. Yeah.
Okay, you on the family home, and this is me, rattling some rusty cages in the back of my mind. If I had a property that was 5 hectares and the property was worth $10 million,
yep.
How is that assessed? Is it 1 hectare? Two.
So the family home and the surrounding 2 hectares are exempt assets for Services Australia's perspective.
Yeah. Okay, let's do a practical example.
Yep.
We've got 5 hectares worth $5 million, for example. You would pretty much say that of that $5 million, 2 hectares-ish is the house. So you've got a $3 million asset, a la you might not be eligible for any Centrelink.
Yeah, so we would take out if it was a $5 million block of land, and realistically the other 3 hectares were almost useless scrubbers or pretty, but I can't do anything with it.
Right, okay, cool.
Then there's not much of an asset that you can do anything with. Therefore, if the majority of the asset is still in the family home and surrounding 2 hectares.
So there is some discretion there.
Yeah.
Like if you've got a goat track cliff that's actually not worth anything.
Yes.
That's cute that you've got an extra 4 hectares, but you're only living on the 1 hectare.
Yeah.
Okay,
so,
awesome.
Yeah, so the concept is what would you get on the market if you tried to sell it?
Yeah.
So if we were going to separate that part, the house out from the rest, what would I get on the market if I was going to sell that bit?
Oh, carve off the excess. Yes.
Yeah.
Okay.
And if there's not a lot of value in that, then there's not a lot going on. Now, if that's a 5 hectares in Avalon where somebody can build a unit block on there, then that extra 3 hectares is going to be very, very well valued. But if it's somewhere where it's great for a view, but it's all hills and you can't even put sheep on it, then there's not necessarily a lot of asset value there. So it's realistically what the market would pay.
Yeah. Well, there you go, everyone. I couldn't trick him with a question off the cuff. If I own a $30 million house at Vaucluse that has a nice view of the Harbour Bridge.
Doesn't matter.
Doesn't matter.
No. The only time the home matters is if I'm actually using part of the home to generate an income.
Right.
So if I was running a business, an office out of the home, and there's an area in my home that was exclusively used for their office purposes, then I'm using part of the home to generate an income. Therefore, there's an asset value there. Not the whole house, but just a proportion of the house that's used to do that. Yep. But it's got to be exclusively used to generate an income.
Right.
So if it's being used for other purposes and generates an income at the same time, we'll count the income, but we won't necessarily count the asset.
The income under the income test, which would that fall into the same type of, and we will get to it in the next question, would that income be in the same pool as I'm working casually 2 days a week as a shopkeeper and 1 day a week is Airbnb?
Yep,
it's all the same income.
Yes and no.
We might have got him.
No. It's just that no, you haven't got me. Don't be silly. No, it's not that it's. It is treated as income, but we assess different sorts of income differently.
Right. Okay.
So that's what I'm trying to get at.
Yes.
So if it was an Airbnb, we would basically be looking at if I'm generating a profit. If it's a wage, it's the gross wage. So although we've got different sources of income, they're not treated the same way. But from the family home perspective, what I was going to say is if you are actually thinking of doing something like an Airbnb, that's when you really absolutely want to speak to the Financial Information Service beforehand, because there could have significant unexpected consequences, and the guys at the pub don't necessarily know what they're talking about.
Generally don't.
Yeah, so call and speak to the Financial Information Service, explain what you're thinking, because we're allowed to talk through what the implications of your thoughts might be.
Yes.
Because once you've done it, you're stuck. So if you come in and tell us that you've done something, as you're talking about, you can't necessarily pull that apart, and then the complications have happened. But if you speak to us about it beforehand, got the information to make the right decision, know what you're getting yourself into.
Okay, let's go to eligibility. Talk to us about the key rules when it comes to eligibility, and what if someone is born overseas and may get pension from overseas?
Sure. So in order for you to be eligible for an age pension, rule number one, it's age pension, so you've got to be age pension age. You've got to be old enough. Age pension age is 67. We've talked about that already. Rule number two, you've got to meet our residence requirements. So being born overseas isn't a defining feature. Being an Australian citizen isn't what we're looking at here. What we're looking at is 10 years of residence in Australia.
Unbroken?
No, 5 years have to be unbroken.
Yes, okay.
So 10 years in total, 5 years unbroken. If you've got 5 years continuous residence plus 10 years in total, then you meet the residence requirements. Then we're talking about basically the income and assets test for the pension. So in order to get a pension, it is income and assets tested. You've got to have income and assets under the limits in order for the payment to be made.
Okay, just on that. So the 10 years in total, so the snapshot is a 10-year. So leading up to age 67, from age 57, is it I have to be 5 years unbroken within the 10 years?
Well, it would be,
okay, so
it could be 2 years here, 2 years there, a year in the past, and then 5 years in between. It doesn't really matter. It could be spread over 15 years or 20 years, as long as there's that residency is 10 years in total with 5 years unbroken.
Okay, cool. So I could literally be born in Australia, I'm a citizen, I'm a resident, at age 10, move to Prague, at age 62, come back to Australia, and then have my 5 years unbroken from 62 to 67.
Yep.
Okay.
Yep. So that brings up the question of the pensions from overseas. If I have lived or worked in another country and I've potentially been making contributions to the pension in that other country, and I'm now in Australia and living in Australia and applying for an Australian age pension, we are going to check to see, are you eligible to get a pension from that other country? And if you haven't applied for it already, we're going to strongly encourage you to do that, and we're going to help you to do that for two reasons. First one is you contributed, you're entitled, so take advantage of it. And the second one is the more support you get from another country, therefore potentially less pension that the taxpayer in Australia has to pay. So you're getting the benefits of, if you like, both circumstances coming together. But the fact that you've lived or worked in another country does not stop you. And when it comes to the 10 years, I should also point out that we have Social Security agreements with a lot of different countries around the world. And if you've been living in one of those countries that we have in a Social Security agreement with, then the period of time that you live in that country can count to your eligibility for a pension with us as well. Yeah.
And before everyone says, ask the question about when I'm on the pension and want to travel overseas, well, we'll answer that in next episode.
We will.
So this is all about before the age pension.
Absolutely is.
So talk to us about the income and asset tests that are current as at the 1st of July, 2025.
Yeah. So, as we said, in order for you to get a pension, you've got to have accessible income and accessible assets under the limits. And those limits actually change 3 times a year. They change on the 20th of March, 1st of July, 20th September. On the 20th of March and the 20th of September, the rate of pension itself is indexed. On the 1st of July, what we call the income and asset-free areas, the amount that you can earn or the amount that you can own before your pension's affected, they get indexed. And as a consequence, the cut-off points where the pension can't be paid goes up. So on the 1st of July this year, if you are a single person, then you are allowed to earn $65,416 per annum in accessible income and still get some pension under the income test. If you're a member of a couple, that figure is $99,954.40 per annum in combined accessible income. Now, one of the questions that we are always asked when we talk about a member of a couple is, what if I'm on a pension but my partner is younger and not on a pension? Are we single or a member of a couple? You are a member of a couple. If you've got different financial arrangements, you're still a member of a couple. If you're a couple, you're a couple. That's the way that we do it.
So if one of the members of the couple is 67 and ticks the eligibility box and their younger spouse is in the peak of their career earning $400,000 a year as a CEO, you might not get age pension.
If they're earning $400,000, you're not going to get an age pension because we're going to look at their income and work out your pension based on both of your combined income. Now, those figures are actually potentially higher if you are still working. So if there's wages or if there's income from self-employment, then we have this thing called the work bonus, which actually means that we're going to ignore more of that income and potentially have less of an impact on your pension than you thought. So those figures will be higher if you're working. Under the assets test, as a single person, if you own the home that you live in, you're allowed to have $704,500 in accessible assets apart from the family home because we already said it's exempt. For a member of a couple, that's $1,059,000 in combined accessible assets before the pension stops under the assets test. And again, those figures are higher if you don't own the home that you're living in. So if you're renting in a flat or something along those lines. For the full list, lots of numbers that we just thrown out there. Go to our website, servicesaustralia.gov.au. Look up the panel at the front that best suits your circumstances, and that'll give you the latest figures based on the 1st of July change.
So what's the current pension as at the 1st of July for a single?
I don't...
Because I was just looking for the updated one.
It's 1,000... Where is it? Here it is. I got you. And you have this. And see, you thought we have me? I haven't.
No, we got you.
The full rate of pension for a single person is presently $1,149 a fortnight. That didn't change on the 1st of July.
Okay.
So that only changes on the 20th of March and 20th September. And for the member of a couple, it's $866.10 a fortnight each.
Okay. So the single pension is $29,874 a year, and the and this is for homeowner, I assume. Yep. And for a couple, it's $22,000
each.
Each.
Yep.
Okay. Cool.
Yep.
Which times 2 is 45,032. Is that about right?
Yep. That'd be about right.
So, gosh, it's a big difference.
To lose eligibility at So the way the income test is designed to work is actually to say you can earn an income. And one of the things that we know is that quite a few people actually delay applying for a pension because they think they have to be retired, and you do not have to be retired.
Okay. Question, if there was a couple both on age pension and on a full pension homeowner getting the full $45,000 a year or the $866 a fortnight each.
Yep.
Do you have the amount where after the threshold of working, because you've got the cutoff point being 65 grand, can they earn 10 grand a year without impacting it?
So that's when we would be talking in the next episode about the work bonus and things going on.
Okay.
We do have that figure, absolutely.
Okay, we'll do that in the next episode, which will be next week if you're listening to this live. We've talked about dual citizens. Okay, let's swing back around. We pegged it at the front about eligibility.
Yep.
When you might be a self-funded retiree. What can one receive if they're not on age pension?
Sure. So most people know about your blue pension concession card. So if you're getting an age pension or a disability support pension or carer payment, then you get a pensioner concession card. But you have to get a pension to get one of those. If you're a self-funded retiree, you won't get one because you're not getting a pension. There is a concession card that you can still take advantage of. It's called the Commonwealth Seniors Health Card. Now, the big thing about the Commonwealth Seniors Health Card is that it's not assets tested.
Right.
So it may be that I'm not eligible for pension because my assets are too high, but I may be eligible for the Commonwealth Seniors Health Card because there's no assets test. And actually the income test on it is higher than the pension income test.
What would that be-ish?
It will be. So in order for you to be eligible for Commonwealth Seniors Health Card, you've got to be, again, age pension age. So it's for older Australians. So you've got to be 67 years or older. You've got to meet the residence requirements, which aren't the same as the pension. So check the website for those. But the income test for the Commonwealth Seniors Health Card, if I am a single person, it's $99,025 per annum in assessable income. For a member of a couple, that figure is $158,440 combined in assessable income. So significantly bigger than the pension. And the income test for the Commonwealth Seniors Health Card is actually relatively simple in comparison. It's your adjusted taxable income plus the deemed interest from your account-based pensions.
Right, and we'll do deeming in the next episode.
Yes, so it's just a fixed rate of income that we use. That we add that for the Commonwealth Seniors Health Card, and we talk about it in the next episode. So basically what that means is
what do you basically you get the medicines for cheaper, any prescriptions?
Yes. So it gives you pretty much the same medical benefits as your pensioner concession card does. The difference is often not in that, it's what the states actually provide.
Yeah.
So a lot of the benefits of your pensioner concession card and your council rates, your water rates, your car registration, your driver's licenses are all state or territory supports rather than federal government supports.
And the state just outsource the criteria to that card, basically.
Yes.
Yeah.
So they may, and states are different. Different states have different benefits. They provide different rates. So there may also be other supports available through the Commonwealth Seniors Health Card. What I recommend is that you have a look at what your state or territory government offers on their website to find out how it can work for you.
Yeah. Okay. What or how, I lost my little question page here. With applying, how can I apply and when should I apply?
Sure.
For the age pension.
Well, and also for the Commonwealth Seniors Health Card.
Yeah.
Basically, you can do that as well. So for the age pension in particular, the two tips for the age pension is, number one, you can lodge an application up to 13 weeks before you become eligible.
Yeah.
Now, that could be 13 weeks before you turn 67, or it could be 13 weeks before you retire. If you knew you were going to retire on the 1st of July.
At age 70.
At age 70.
Yep.
You've got the evidence from your employer that this is all setting. This is not just I thought I'll do it, but I've officially put all the paperwork in. Then you can actually apply for the pension up to 13 weeks before that date as well. So tip number one, apply early.
Now, at the risk of being cheeky and being cancelled by the government and debanked and all that myself, is that because of the processing time more than anything?
It's going to make it much easier for everybody as well because there's a lot of documentation that you need to provide. There may be extra questions that need to be asked. We might need to write to third parties. All of that is happening in the background while you're waiting for that 13-week window to pass. Now, if you lodged on You had nothing better to do on your birthday and you lodged on your 67th birthday and it took us 3 months to grant. We'll still backdate it to your 67th birthday. It's
Is there a sunset clause on backdating? Like if I was turned 67, whoops, I've been in a coma for a year, woke up, oh crap, it's been a year. Will you backdate it to then?
The application for the pension will only go from the date the pension is lodged. So your eligibility only starts when an application for the pension is lodged.
And that's a big thing.
Which is why we're saying to customers, certainly if you're working, don't assume you don't have a pension eligibility just because you're working.
Yeah.
Check it out beforehand because that's money you're missing out on if you have that eligibility. Yeah.
A question, and I think it was, I've just been out of the game so long. You can go and get a profile set up on Services Australia. Does that before you apply or?
Well, yeah, you can register your MyGov account with your Centrelink record.
Right.
And that's the other tip is actually how to apply.
Yes.
And this is for the Commonwealth Sydney's health card as well. The best way to apply is online. So it's your MyGov account linked to your Centrelink record. And the reason that we suggest that, there's a couple of big benefits. Number one is you're able to track your claim so you can see where it's going.
And it's accurate data matching, right?
Well, that's going to happen eventually when the proper information is put in. So we need you still to provide information. We're expecting you to give us the stuff we need for the application. But the thing about the application for the age pension is that it covers almost every circumstance that a human being could potentially come up with, which 90% of them may have nothing to do with you. And if I do an age pension paper form, I've actually got to go through all those responses and say, no, 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 no. When I go online, it's intuitive. It will, you've said no to that, therefore there's 15 questions more I don't need to ask you. And it just makes it a much simpler and streamlined process. So very strongly encourage people, if we're at all capable, to go online for an easier and quicker age pension process.
Yeah. Hey, it's Glen here. Thank you so much for watching today's video. You made it to the end. Can I ask a favor? Can you hit that like button and maybe hit subscribe if you want to get notified when we release further videos just like this one, whether you watch the Money, Money, Money podcast or Retire Right. And remember, if you want to learn more about investing, I've got an investing book, The Quick Start Guide to Investing, and there's a link in the description to get your hands on a copy. Thank you so much. Bye.